Hello, everyone, and welcome to Carta Policy Live, a video series where we analyze the key policy events and what they mean for private markets and the innovation economy. Today, we have a special focus, the SEC's rulemaking agenda, and specifically recent developments on the private fund advisor rules. Had this rule gone into effect, it would have shaped how GPs raise capital, communicate with their LPs, and also impose new disclosure requirements on them. It would have been a major shift in how GPs operate. Fortunately, we have the right person with us today to talk about the rule and what happened recently. I'm joined by my colleague, Holly Hiles-Pandel. So Holly, let's dive in. There's important developments this week where the Fifth Circuit reversed the SEC's PFA rules. It's a major win for the industry. But before we talk about the case and its implications, can you give us a quick refresher on the rule?
Sure, and I agree. It was a big week indeed. Just as a reminder, so the SEC adopted the private fund advisor rules last August, and this slate of rules would significantly change not only how venture capital funds and private equity funds operate, but also how they are regulated. These rules applied to all private fund advisors, regardless if they were registered or not, in some cases, and then advisors of any size. So for RIAs or registered investment advisors, there were a number of requirements that would have required things like new detailed and prescriptive quarterly statements that had to be reported to LPs around fund fees, expenses, and performance, as well as audit requirements. And for GP-led secondaries, there would need to be a fairness opinion or evaluation opinion. And then for all private fund advisors, this is ERAs, exempt reporting advisors, or RIAs, you would have had to have disclosed side letter terms, both new side letter terms and existing side letter terms. And in some cases, if those terms had a material economic impact, those would have had to have been disclosed before an investment was made, as well as other restrictions on how certain expenses could be charged to the fund. Now, these rules were significantly moderated from the original proposal, and this was largely due to engagement from Carta and others in the private fund ecosystem, but they were still a substantial shift in the way private funds are regulated and operate.
Thanks for setting that foundation. And to your point, yes, this would have been a major change in practices and operations and requirements, which is why we saw industry take the very drastic step of actually suing the regulator over the rule. Can you walk us through the case and the court's decision?
Yeah, so a number of private fund trade associations challenged the rule in the Fifth Circuit on a number of procedural grounds. But at the heart of it was that the SEC lacked the authority in the first place to put forth this rulemaking package. So private funds are explicitly exempt from SEC regulation and statute. The agency only has limited oversight and regulatory authority over private fund advisors, as opposed to other investment advisors and investment companies' funds that serve more retail-facing customers. This distinction is largely because private markets are limited as to who can invest in them, and these are investors mainly accredited that the agency is determined to be sophisticated. So the SEC relied on two major rulemaking authorities to prescribe these rules under the Investment Advisors Act. One is something I'll refer to as Section 211H. This authority came from Dodd-Frank, but the court held that this authority, as prescribed by Dodd-Frank, only applies to retail customers, not those sophisticated investors that invest in private funds. And then secondly, and this is probably the most important part of the case, the court found that the SEC did not appropriately use its anti-fraud authority, or you hear this referred to as Section 206 sometimes in the Advisors Act. For one thing, the court found that the agency did not provide enough of a factual basis, enough evidence of fraud in the private fund space to justify the new requirements in the rule, as well as, the court put down a pretty stark marker that this authority can't be used as the basis for a disclosure-based rulemaking. You have to have some other section of the Advisors Act, some other authority to prescribe these types of rules. And this is going to have a much bigger impact, broader ramifications, even beyond the private fund advisor rule, because the SEC uses this anti-fraud authority as the basis for a lot of its rulemaking requirements.
Yeah, the legal aspects of this case are really interesting, and I know we're going to get into some of those implications shortly. But if you would just pull us out of the legal details for a moment, what does this mean for advisors and private funds? Just bottom line it for the folks watching this.
So bottom line, venture capital and private equity fund managers won't have to worry about compliance with these rules, at least in the near term, or maybe even on a permanent basis. They won't be going into effect anytime soon. This is a big victory for the private fund industry. These overly broad requirements are not reflective of how the industry operates. You know, we at Carta, we've been making this case, and the court agreed, finding that the SEC did not have the authority to put these forward.
Yeah. So as we started, big win, big development. This is going to give these managers more time to operate and continue to raise and drive capital and support the innovation economy broadly before any such changes. But I guess the next question is this permanent? What happens next on this matter? The rule was challenged in the Fifth Circuit, a conservative leaning court that has been pushing back, especially as of late, on some of the administrative rulemaking and overreach they've seen. But it doesn't mean the case is potentially over. The SEC does have some options here. What exactly does that look like?
So you're right. The SEC does have the option to appeal. This case was heard by a 3-judge panel in the Fifth Circuit. So the SEC could potentially, appeal to the entire Fifth Circuit to hear the case, or they could go directly to the Supreme Court to petition for review. Now, neither court has to grant said review, but those are the options. And I think the SEC, they have signaled that they are considering their options here. If I had to put money on it, I would assume they would take the latter route, go to the Supreme Court. Just as you noted, the conservative or the Fifth Circuit is one of the more conservative leaning jurisdictions. But bottom line, nothing is going to happen anytime soon. I think, if there's an appeal, and even if that appeal is successful, this is going to stretch far into next year.
Great. So we'll obviously keep folks posted, but just to kind of close the loop on this, with this case done or decided at the Fifth Circuit, we'll find out what the SEC does on the appeals basis. That timeline, however, has been extended quite substantially. So for the most part, GPs, private fund advisors are in the clear, right, Holly?
If only things are that simple. So I would say, as far as the prescriptive requirements under the private fund advisor rule, I don't think you have to redo your quarterly statement reporting templates tomorrow. But, there are still certain aspects and, signal from the SEC that I think you could see, maybe an even bigger focus on. And that's through the examination and enforcement lens. So the SEC put out a number of exam priorities last year that kind of signals where the agency is going to focus its attention. And private fund advisors are a big part of that exam focus. And, some of the areas that they're going to be looking at include things like private fund fees and expenses, disclosures. Are you following the terms of your LPA? How are you conducting your due diligence? A lot of the areas that, the SEC focused on in the private fund advisor rules are also some of those exam priorities. And the SEC has authority to examine not only registered private fund advisors, but they can look at exempt reporting advisors as well. Now, historically, that has only been more on a for-cause basis, but we've been hearing anecdotally that they're stepping up more routine exams, even on the ERA, exempt reporting advisor side. So that's something to be cognizant of.
Yeah. So just when you think you're out, they pull you back in. Yeah, I regretted that as soon as I said it too. But putting this matter aside for a moment as a rulemaking basis, but kind of returning a little bit to the impact of the legal analysis you discussed a little bit earlier, can you talk a little bit about what this decision might mean for the SEC's current proposals, rules, and potentially, and we'll get into the future rulemaking agenda, but some of the proposals that are out there, as well as a rule or two that's been finalized?
Yeah, so I mean, we've talked about this quite a bit, not only in our policy newsletter, but also on previous previous versions of this live webcast. But the SEC has pursued a pretty substantial aggressive agenda under Chair Gensler with respect to private fund advisors. So if you look at the authority they use for private fund advisor, there's a number of other items on the rulemaking agenda that the SEC has proposed that could the impacts of this case could shape how those items look like moving forward. These are things like new changes to custody requirements and the predictive data analytics rule, which largely is looking at how funds use technology, how funds use artificial intelligence. And there has been some signal that the SEC may pull those back, repropose, or at least address how some of those aspects in those proposals have how the agency is thinking about those given some of the pushback. But this case will undoubtedly impact how they're thinking through that process, because a lot of the same authorities underline those rulemakings. But there's also rules that are currently on the books, that have, disclosures with respect to private fund advisors that we could see even potentially challenged after this rule. One example is the marketing rule, which I know, we've talked to a lot of Carta's customers that are, struggling through interpreting and some of the guidance that's come out with respect to that. But, it's a disclosure-based rule for private fund advisors that we could see a little more scrutiny from this decision.
Yeah, and it'll be interesting to see how that unfolds, both for things like marketing, which is already on the books, as well as some of those proposals that you mentioned. They'd already signaled they might kind of pull back a little bit, what this case does for all that. Yeah. I would just note, this is something that we're constantly engaged on at Carta, both directly with customers, as well as doing these types of virtual events and putting out our newsletter. And so we'll obviously keep folks apprised of any developments on those fronts or signals we're getting of those going in a specific direction. But even outside of the proposals and rules that might be now a little bit more affected given the legal challenge or the court decision, the SEC still has a forward-looking agenda that still has many prongs previewed through its regulatory flex agenda that would affect and impact private markets. And most of those would seem, and we'll find out what they ultimately look like, but would seem squarely within the jurisdiction or authority of the SEC. Can you walk through what's on that agenda and how we should be thinking about it?
No, that's a great point. Yes, we've talked a lot today just about, how the agenda, how these rules would apply to private fund advisors, but the SEC does have a much broader private market agenda. And I think one of the items that's still outstanding that we have not seen a proposal come down the pike yet is with respect to Regulation D, which is the primary means by which capital is raised in the private markets, both from the private company side and as well as private funds. So as I mentioned, this hasn't been proposed yet, but we have at least gotten some signal as to where the agency may go when a proposal comes out. And I'll talk about this in two prongs. One is the accredited investor standards, and this largely determines who can invest in private markets. They are largely wealth and income based, and those financial thresholds have not been updated since they were adopted in the 1980s. So we've seen some push, particularly from the progressive side, to maybe not go so far as indexing them for inflation, but adjusting them in an upward fashion, which could have a pretty substantial impact on emerging ecosystems, especially lower cost of living areas. The other aspect of what we could see come out with respect to Regulation D is more on the operational side and through things like the filing of the Form D. Now, there are a couple of things that the SEC could do with respect to that process. One would be to require pre-filing or closing amendments with the Form D. And the Form D is a public-facing form that signals, the capital raise. And then they could also give Form D more teeth by, if you're not filing the Form D, do you lose access to that exemption, which would mean you would have had to have registered your securities or face potential enforcement action and even rescission. And then, one other thing that we have seen signaled from at least one Democratic commissioner is, do we impose a public-like disclosure regime with respect to Regulation D? This could be done either by requiring more information on the filing of the form, or for particularly larger capital raises under Regulation D, do we create a almost, public company-like reporting regime?
Yeah, so a lot still on the agenda and a lot at stake here, because even outside of this most recent court decision, that forward-looking agenda would drastically impact not only who has access to private markets, a la the accredited investor standard, but how those operators, whether those are funds or companies, would kind of navigate it, whether they need to start signaling to the market that they're raising money through a pre-filing of Form D, and or what types of disclosures would come along not only with the Form D, but potentially a public company light disclosure. And so it's really still very much in the line of sight of the SEC as to how private markets go. So with that, Holly, I do want to thank you for all that you've shared and educated us on. Just to recap, there's still aspects in the private fund advisor rule that will unfold, but given the court's recent decision, we've got positive signal that the regulation will not go into effect in the near term, if at all. As this develops, Carta will, of course, keep everyone posted, engaging the ecosystem to help them understand and navigate it. And as we've talked about a little bit in the past, we were actually in the process of building products to make sure folks could comply with this. That's obviously something we would renew if this were to start coming back. But that's true, I think, in a lot of other areas as policy creates friction points. But I would say, just to close on a bit of a larger point, the fact remains that as private markets grow, so will policymaker scrutiny of these markets. And so this rule, had the court not rejected it or overturned it, would have changed how GPs operate. Holly, at the end of this, talk through the forward-looking agenda as to what that would ultimately mean for raising capital and operating in private markets. And I think it's really important to note that engagement is going to matter throughout all of this. And private markets framework is going to evolve, and it's on us to help engage and ultimately shape what that evolution looks like. And so we'd ask you all to stay tuned and stay engaged. Please visit us at the Carta Policy Desk, subscribe to our weekly newsletter, and tune in for our next Policy Live. As always, thanks for joining us, and we look forward to seeing you next time.